What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show.
Go to gold because I love Weimar. I love Nostra's perspective. Did you guys see the momentum in gold today?
Yeah, I did. That it's actually a really odd move. I mean, stocks are up a lot, so it's like a risk-off day. And real yields have been rising too, because obviously inflation's been falling and interest rates are up. The flip side is the DXY has been pretty weak, but it really wasn't today. So it's interesting that it's rising. One thing I'll highlight though is China dropped their treasury holdings once again, a new 13-year low. Even the person in the Reuters article called out that might have some geopolitical implications.
Do you have the number? How much was the
I
reduction?
think it was like 20 or 30 billion off the top of my head. But they've been doing that for months now, and they've been increasing their gold holdings. And frankly, so have a lot of countries. I mean, we've been in a bit of a central bank gold buying cycle. I suspect that's providing a lot of the support. So, yeah, it's a bunch of stuff, but gold's actually really strong given where the rest of the economy is. Sorry, my music's on.
Yeah, I mean, gold has been ripping too. I think like the precious metals have been doing fairly well as well.
Yeah,
So
silver's
not
over
only
25.
gold, yeah, silver's been doing really well. And you know what's like kind of interesting? Let me see if I can find it. Bob tweeted out. Just basically like how the precious metals perform over time, like a yearly chart. And it seems like always towards the end of the year, we always see like gold and
Yeah,
silver.
Brandon, I think you're talking about the aggregate seasonal adjustment of the price of gold, right?
Yeah.
Yeah, because I think June 30th tends to be the low, and then it rallies towards the end of the year into January. And that's usually because there's a lot of Asian holidays in the fall.
Yeah. Oh, okay. I didn't know that. Yeah, I just posted the silver one, and then here's the gold one. Yeah, I always found it kind of interesting, but yeah.
And I do see we have Bill back. Thanks for coming back, Bill. I appreciate that. How are you doing?
Oh, where'd the Marxist go?
You scared the commie away, Bill?
I started shouting.
Well, no, I figured two Austrians here versus a commie. This was going to be a knockdown dragout. That's why I came back.
No, but he was lecturing. He was just presenting his lecture.
It wasn't even lecturing. It was a word salad.
And it was really hard. And like, look, I feel bad.
He wasn't interested in any discussion. He just wanted an audience where he could just spout his word salad.
Isn't that odd, Bill, that a commie is selfish? Isn't that odd?
It is odd. Hard to believe, actually. No, but I actually, there's some smart people here, so it's now it's interesting. I got to bring my A game when Weimar and Nostra are here, and David and Greek Camp.
I thought you were going to name me, Bill. I was like, man. But yeah, Bill, welcome back. I appreciate it. I thought you weren't going to name me for a second. I was like, oh man.
No. There's actually people down in the audience too that are really sharp as well. That if they want to come up, but so Weimar, what's happening with the bank results so far? It's kind of been an interesting first pass of bank reports. What do you think? NIMs are definitely compressed. NIMs are compressing, right?
GSIBs are fairly strong. I mean, Citi was a little weak. I'd say Wells Fargo was decent. JP Morgan was excellent, but I was not surprised at all by JP Morgan. They've been a huge beneficiary of all this. The two that have done poorly, in my opinion, although the stock didn't reflect it, like PNC was pretty bad for a super regional and they cut guidance. And
I agree. PNC looked a bit weak,
and they were up, so I was like, okay, whatever. Schwab, that was one I never really even understood why they had a run, to be honest, but they did.
Well, it was their bank sub. Their bank sub was severely under.
Yeah, they had. Then they lost a lot of money by being unhedged, having the securities. But they're in a
Yeah,
much
I don't think
stronger
anybody
position.
was worried. I don't think anybody was worried about
Yeah.
Schwab, sort of the broker, but I think they were worried that they would need to raise
Yeah,
capital
yeah,
to plug the hole.
and that's the thing that's coming too for all of them, so they know that. The one that reported after hours, which did look bad, Western Alliance, but they're touting the fact that they managed to grow deposits, and they sold off a bunch of assets in the quarter. I think it was like $3.5 billion or something like that. The other one that was bad was State Street, which isn't really as relevant for your typical bank. That's a little bit more like your BNY Mellon, your Northern Trust, etc. Although they've had some issues too, obviously, and their NIM compression caught people, I think, a little bit by surprise because of how big they are and how they're kind of more of a custody type bank, and they earn a lot of fee revenue and stuff like that. So that's been interesting. The one I've been actually paying the most attention to are the little tiny banks, sort of under 10 billion, and they're kind of all over the place. But one more or less consistent thing is they all, and this is, I think a lot of the smaller banks are doing this because they don't want to seem like they're imprudent. They're citing the cuts to lending, or lending they've done, and the tightening of the lending standards. And if they had particularly construction, commercial real estate, they talk about like where that stands and stuff. So it's interesting if you read some of these smaller banks, like a good one like FB Financial. Yesterday I posted about them, and there was another like Community Bank Shares bank, and these are like 5 to 10 billion each. And those are kind of your more typical regionals. The only big regional we've had so far was PNC, but there's a lot more to come, obviously.
Yeah, I actually thought Synchrony Financial looked pretty good, all things considered. I know you'll probably disagree, but
No, I actually,
they
Bill,
look
I
awfully.
don't disagree. Actually, they turned around they had that problem where their charge-offs were rising for a few months, and it looks like that went the other way this month. So that's a good sign. And then, funny story, I actually finally got a mailer right as I get home from them pitching me a new credit card, which is weird because Synchrony, as far as I knew, never had its own credit card, but they're basically selling me a 2% anywhere credit card from Synchrony directly. So it's not a merchant credit card. You know what I mean? I've never gotten a mailer.
Yeah. Well, that's their big business, right? They do the private label store
Yes,
credit card.
exactly. So we used to use them when I worked at Lowe's back. They were GE Capital back then. In fact, my old boss used to work there back in the day at GE Capital. And Synchrony is the new name they gave GE Capital after they spun out of GE and after the banking crisis. But they do the Amazon card. They do the Lowe's card. They do I think a few other big retailers. They're the card behind them. So they're the one taking most of the credit risk. And they're considered the riskiest probably of all the mainstream credit card companies because those kind of cards have the highest charge-off rates. And you'll see that in their earnings. Like they typically have a much higher charge-off rate, but correspondingly they tend to earn a bit of a bigger NIM. They charge a little higher rate for that. So
Yeah, I mean, they tend to be the sort of they're never the front of the wallet card that you go to first, right? They're always the ones that get, after all the other cards get overloaded, they're in the worst position. They get used only when, the consumer's already pretty full up on the other credit cards. And so they don't really get the high interchange fees. They get a disproportionate amount of the losses. But like you said, they make a lot on fees and stuff. But no, they look awfully good. And at 6 PE ratio, I mean,
well, be careful with PEs on banks because the credit can.
I know. I'm just saying
a lot of the banks look really nice, but one thing I'll say, they did do, like you said, they're cutting unused lines. I think they're worried about what you're talking about. So if a customer's sitting out there with a store card they haven't used in 2 years, they commented, and there's a Bloomberg article I posted about it, that they're cutting some of those lines. So that's a type of asset action called line management.
Anyway, it's still early, but it's going to be interesting to see kind of all of these different companies, especially now as we get to the super regionals and regionals, where I think they have more of the CRE exposure and probably like PNC starting to see some of the NIM compression.
Yeah, and Goldman's going to be really interesting given all the chatter around that. And there was just a story about the new strategy they're pursuing because Goldman, for a long time, in fact, they recruited someone from my old bank to do this. They started their own consumer division. And you'll recall a few months ago, they were touting the new Apple deposits, and Goldman Marcus was the bank behind that. And then they did a total reversal. They pulled out of it. When they had the CCAR results, they had huge losses in consumer. So they have a whole bunch of issues in credit and consumer. They weren't as good at consumer as they thought, and it's like they backed away from it. And on top of that, they kind of lost the top spot in investment banking, I believe, to Morgan Stanley, but I think JP Morgan's up there too. So they're kind of like rethinking their whole strategy now because of that. And it looks like they're going to rejigger towards back to investment banking and sort of what they've traditionally been good at. But Goldman's always an interesting one because they're usually ahead of the curve from on everyone in banking. So it's interesting.
Yeah, I'm less interested in the investment banks. I'm more interested, mainly because I know sort of deal flows kind of dried up. Maybe it's picking up now. I don't know, but I'm more interested sort of in the card companies and the basically traditional banks, to see kind of what they report. And then honestly, the other area I'm going to be interested in, which I know is dear to your heart, is I'm going to be very interested to see kind of how the subprime auto lenders report. They'll be coming up soon too.
It's funny you mentioned that. That was never one that I believed in because for years we heard about subprime auto and how it was the next shoe to fall. But now I've turned very bearish on it, just based on some stuff I heard. But I think they're tightening. I think they've tightened the credit standards really hard on subprime. In fact, I've heard that from quite a few people now. So it's interesting. And then you got to keep in mind the collateral is falling. So the lender with an auto, you like, I just got a 0% down auto loan, right? So what, like $30-some thousand Mazda 3, like kind of a high end one, right? And they gave me a 2.9 rate on it. It's new, and I was like, "What do I need to put down?" They're like, "Oh, you don't have to put anything down." So even with some of the lower credit scores, because I have a pretty good credit score, and even some of the lower ones, I was like, "What's the lowest bucket?" And he's like, "Oh, you can go down to 700 or something." So I was a little bit like, "Wow, that's interesting." But if the collateral starts to fall on those loans, like when they repo it, obviously there's a hefty cost to repoing it and auctioning it and all that stuff.
If they can actually find the car.
Yeah, if they actually find the car. And that's another thing too. And this will be an interesting dynamic if we have this. Things have gotten a little more tense, particularly in cities, and like it's a lot more dangerous to be a repo man. I used to know people back when I was in college who did it, and it was dangerous then. But now it's like, who the hell wants to do that? So it'll be an interesting dynamic.
If you ever want to watch it's a kind of a weird film. I don't know if you even have ever heard of it, but there's actually a film that came out in the early 80s called Repo Man with Emilio Estevez.
I've seen it.
Yeah,
I've seen it.
Seen it. Repo Men have a code, Weimar. I learned that from that movie.
Yeah. And please enlighten us, Bill. What's this code?
Oh, I can't even remember now. I got to go back and look and watch that one more time. But yeah, it's a weird movie.
Well, isn't Charlie Sheen in it too? Estevez and Sheen.
I don't know. No, I thought it was just Emilio Estevez, but yeah, you might be right.
But I think it's not too much of and this is I guess anecdotal because I didn't do a deep dive here, so take it as it will. But I don't think it's going to be that much of a compression within these auto lenders. In the research that I have done, the mitigation that they were able to do in the first 3 months to 6 months of the vehicle, most of the time when reselling, so this is a big problem, is we might see a offset and a huge increase in actual secondhand vehicles come in due to these repos because of the 3 months to 6 month quotes that they have within the insurance provisions. And this is where they're usually able to offset their increased autos, or I should say increased vehicles that they reobtained throughout the credit consolidation that they've just went through, but usually like at 25 to 15 cents off the dollar type thing.
Yeah, look, I mean, subprime auto lending is sort of a business unto itself that they understand they're lending against a depreciating asset most of the times, other than recent pandemic. They also understand who they're lending to. So it is a business that I think historically actually has done pretty well because it has, it sort of skirts the usury laws by just, being just below state, limits in terms of interest rates. But I mean, the APRs are 18 to 24%. There's usually a dealer holdback as well to sort of, keep the dealer honest. So if anything, I think some of these guys are going to benefit here because the banks are sort of leaving the field. And also, there's been sort of the dealers wouldn't necessarily, given the limited supply of used cars, like they wouldn't go down to subprime, right? When they can make more money, selling their used car or using it as part of a trade-in to a prime borrower. So I'm actually kind of bullish. I know, contrary to Weimar, I'm actually quite bullish on some of these subprime auto lenders who, have a long track record and sort of seem to know what they're doing. Because I think the field, the demand will be coming back to them after sort of disappearing for a couple of years.
But
Now,
shouldn't their
yeah,
prices be more
losses will
depressed?
be high, but they know that and they've built their business model around it.
But if you're going to buy, wouldn't you want their prices to be depressed first? I'm not saying that like a subprime auto lender is going to go away, but they could have several years of reduced or non-existent earnings.
Yeah, no, it's contrary though. Like if you read, like I one of the ones I follow is Credit Acceptance, right? One of their problems has been volumes have been down for them for the last couple of years, and that part of it is because there's too much competition and not enough volume, right? The dealers, like I said, aren't going to give the finance receivable to them because they're not going to entertain sort of a subprime borrower, or weren't willing to for the last couple of years because they could make more money elsewhere. With the banks leaving, that's less competition. So yeah, these guys will price accordingly, right? They'll first off, the volumes will be there, and then they'll price knowing that capital has kind of left that market because the banks are no longer want to do it, simply because for them it doesn't make sense anymore. It's too much. It's too risky. They got balance sheet issues. They got risk weighted asset issues. They don't want to be anywhere near kind of used car auto loans.
Yeah, and to Bill's point, there were last quarter, this was before this quarter, there were already auto lenders in the banking space calling out that they had cut back significantly on auto lending. So that had already started to happen even before the bank crisis. I think a lot of it was just driven by rate and use of capital and stuff like that and liquidity. So yeah, they have definitely pulled back, and it's gotten a lot tighter, I'd say, in the auto space, especially if you're a subprime borrower to get anything. Like you're often paying over 20% if you're getting a loan.
At the end of the day, if we do see some compressions within these auto loans, a bank is the last institution that wants to hold an actual, let's say, vehicle onside their balance sheet. And this is where I think Bill's point is accurate as well when he says that, when we look at the lending practices associated to auto loans, they're significantly more tight and aggressive than that of, let's say, a housing loan or mortgage, I should say, and or other forms of lending practices outside of credit cards. And this is important, and because essentially, if we're going to see, let's say, individuals go through defaults, they're more likely to continue paying their auto loan because they need to go to work, and more likely to stop paying their mortgages because the lending practices and credit rehabilitation are continuously different.
Oh yeah, I mean, in order of priority, what you're going to skip first is your student loan. Because there's all kinds of reasons why.
Well, you can defer that if you lose your job too.
Yeah, that's what I'm saying. Like that's the first one to go, then the credit cards, and then the auto loan is one of the last ones you want to give up, because if that car gets repossessed, how do you get to work, right? That's no car, no job.
And that's exactly it. Most of these, like auto insurance, or I should say auto lenders, have strict 3 to 6 month policies that if they do see compressions, that they repossess the car. And most of the time after the 7th to 8th month, they've already liquidated that car. And like I've just stated, they don't mind having the compression of 20 to 15 cents off the dollar for that vehicle, because they're able to then just reinitiate and repurpose, right?
Oh yeah, exactly. Like if you're if you're a day, you're a contract guy working sort of like day labor, working on a construction site, in South Florida, you lose your pickup truck, you're basically out of work.
Hey, so pivoting a little bit, have you been following what's going on in the auto industry at all? About 2 weeks ago, Ford started doing some layoffs, and they're actually like factory workers.
I think Ford's a
Yeah,
mess.
and then they cut the EV prices for the truck, which is curious to me because I have a friend who bought a Maverick, which is a hybrid, and he bought this back in September. He signed for it. They were supposed to deliver it this May at the latest, and they're pushing back basically to August, maybe later, September. So it's probably going to be a year until he gets his Ford Maverick. Sorry, my cat's in the background whining. And so that's going on. They're laying off workers, they're cutting prices, and then GM comes out and they're like, we can't make cars fast enough. So it's like, it's very interesting.
I think Ford has jumped the shark and gone kind of full EV without really having sort of the cost structure to do it. And I think they're in kind of big trouble, actually. And that's why I think, look, I'm not a big Tesla guy. I don't want to start getting into a whole Tesla debate, but I think one of the reasons why Tesla is aggressively cutting prices is because they know someone like Ford's in a bit of trouble. And they're, it's kind of like one of these sort of competitive gamesmanship things.
Yeah, and one thing I know about Ford is they were a heavy participant in both asset-backed securities when I was at a bank that did those, and also retail notes, which were a product where they issue basically unsecured debt directly to consumers. And I actually set up the retail note program in part at the company, the bank I worked at. And we couldn't even get traction. We were in it for like 2 or 3 years. We got very little uptake, and it was a lot of work to keep the program going. But basically, all the volume would go to Ford. So I'm curious how that program is faring in these times of high rates and high offered yields to consumers.
Yeah, I think one of the things that's going to be interesting, like leaving subprime sort of aside, is, and again, you and I probably again may agree to disagree, but my main takeaway from that New York Fed credit survey that just came out yesterday, I think it was the prime and super prime type borrowers. That demand is sort of falling off the cliff for more credit. They're just not applying for anything, and I think some of it is their balance sheet is probably in good shape, but the other thing is there's kind of like they're not happy with rates, so they're just gonna go to the sidelines, and that's why you're starting to see some sort of inflection points in some consumer debt levels, right, where they're just disappearing. And the reason I say that is it's going to be interesting to see how the auto manufacturers react to that, right? Like I suspect you're going to start to see sharper discounts and sharper pricing on auto loans for prime borrowers who are buying new cars, right?
Oh,
And to that
100%.
point,
Yeah.
just anecdotally, right? We saw exactly the same propensity within personal lines of credit, right? Essentially, these prime borrowers are getting offered. They're getting offered.
Well, Weimar just said Weimar's getting all these credit card things in the mail.
Well, hold on.
He sounds
That's
like
the first
he's
one
super
I've
prime.
gotten in a while. And I'll say this, they were markedly reduced. The thing I was getting a lot of were offers for bank accounts, like big $500, $600, open a BMO account, open a savings account, you get $700 because they wanted my deposits more than my credit card business. But I'll say one thing about the credit card business. Super prime isn't always as attractive, particularly at a time of high rates, because they don't always revolve balances. You make your money on revolvers. And if you have somebody who pays off every month,
But aren't they bigger spenders, so you get more
interchange though is capped out. It's like you're going to earn with the rewards. I've seen the numbers. It's like often less than 1% because you often give over half interchange
You're right,
back.
because they have to plow it
Yeah,
back. Yeah, you're
yeah.
right.
So like right now, you actually probably want to be targeting those middle FICOs, like 720 to 750. High enough credit, they're going to not default, but they're also going to have a revolving balance with you, so you can earn something on them because it's a high NIM product.
And usually a week to 4 days late on their payments, where you're incurring as much interest as you can, right? Those are your prime lending.
I mean, penalties have gone down a lot for a lot of these cards. You'd be surprised. But yeah, I mean, that can be a component. But you can actually see that in their earnings, if you're curious.
And I think that's where it's like important to note, right? Like there is a lowering like will for these for basic individuals to actually acquire new credit, and whether that's a continuing let's say habit that's going to manifest for a longer term, that's a bigger question, right? Because that has underlying problems. Wouldn't you agree, Bill?
Yeah, I mean, I don't know how. I think it's too early still, but I don't know how this is going to manifest itself, right? Like, savings rates are picking up, but they're not really, ramping up big yet, right? We're still kind of below. The saving rate still seems to be, in aggregate, below sort of pre-pandemic. So I don't know where the money's going. Like, but you are hearing that anecdotally that maybe there's some more pay down happening, right? Like maybe it's, who knows, maybe it's going to go into student loans. People are going to start paying their principal, even if let's say is it deferment? Is that the official term, that once that stops?
Well, yeah, if you
Um,
get laid off though, you get to do it again. You get like another period that you can apply for. I think it's every time you get laid off, you can apply again if it's a federal student loan.
right,
Yeah.
right. But some of them are even if some of them are still probably going to take advantage and start paying down, right, the principal.
Oh, for
So
sure, for sure.
even if so I don't know where the money's going to go. It'll be interesting to see once student loans sort of restart what happens, right? But I think the government's also getting ready to kind of foam the runway, so to speak, for these borrowers. So I doubt there's going to be a lot of strict application of payment.
One other thing I'll
And even though I
highlight: if you have a
announced
high
program,
balance right now and you're seeing, because what credit cards usually do is they float off prime, and the people who pay interest have probably begun to notice they're paying quite a bit more in interest. Maybe they were at 12 before, or 15 spread to prime, and now it's gone up, 550 or whatever it's going to be. So it'll be, they're noticing that impact every month.
hey Weimar, question for you: why are deposits going back up? I thought they were shrinking.
It depends on the week, but a lot of it's being driven actually right now by the foreign chartered banks. If you look at the data for like the last month or two, they're responsible for most of the delta in deposits. And I think the main reason is they're paying up, and a lot of it's happening in the brokered market. Also, the Canadian banks are paying really high rates right now. The big, like the ones that have access in America, I always point out CIBC's at 536 and BMO on their 1 year CD. These are both 1 year CDs I'm quoting. BMO's at 525. And then the Bank of China is always out there issuing. They're out of Hong Kong. They're always issuing heavy in the BCD market right now. So I don't know how much of it's that, but it seems like a good chunk of it when I look at the H8 data weekly is going to those foreign chartered banks.
Yeah, I should take a closer look. I don't really go into the divisions between large, small, and foreign, but that makes sense.
I built a spreadsheet that does it all automatically. Maybe I can send it to you, Bill.
Okay, cool. Do you have like a time series going back?
I actually do, but that's from Bloomberg. But yeah, I could get that too. Actually, quick thing for everybody on the call: the Fred thing has an API for Excel. It's actually really easy to install, and you can literally pull all this data like live right into spreadsheets as it comes out. It's really cool, actually. But that's not what I have.
Okay. I got to go play around with that. That's interesting. Use a lot of that data, although I typically go to like the U.S. Treasury's daily website or other sites.
Yeah, you could build polls for this real quick. I think it takes like 15 minutes after the Treasury comes out. It'll be updated and you're good to go. But yeah.
I just want like ChatGPT to start building the Python code.
Bill,
Yeah.
do you currently write in Python?
It's been 10 years, man. No, not anymore.
But at least you know how to code. That's the main priority, right?
My first job was coding, actually, out of school, yeah. But it was COBOL, and now I'm dating myself.
Do you know C++?
That's fantastic.
What's that?
Sasha, sorry, I interrupted you.
I think Nastra asked if you knew C++, Bill.
No, that one I don't know. Sorry.
What about Ruby on Rails? You know that one?
Okay, that's listen. That's all I got, man. That's it.
So, Bill, did you work?
This river does not run deep.
Did you work at a bank then? If you knew COBOL, did you do the work on a mainframe computer?
I hate to say it, I used to work for one of the big audit firms, Arthur.
Oh, okay. So out of Chicago.
But on the good side, the consulting side, not the crook side.
Got it. Yeah. They were out of Chicago, so they were one of the ones we lost.
Oh yeah, I used to go to the St. Charles training facility. I guess now that doesn't exist.
I grew up right there, man, by Elgin, South Elgin. It's right next to St. Charles.
Do they still have that hospital that used to have the newborns in the window in St. Charles?
We
used to go there.
No, I don't think so. Not even.
Bill is an auditor. It all makes sense now.
He's a consultant.
I feel like I'm still.
I was a consultant. Not an auditor, man. I do not have an accounting degree.
I was gonna say I feel like CIBC still uses some of your programs that you've developed earlier back in the day. That's how redundant CIBC is.
I saw
But not to say that you weren't I'm an asshole there. Sorry.
I saw a headline today about CIBC highlighting a consumer uptick after a slowdown in May in June. So I don't know if you saw that, David.
Sorry, can you repeat that one more? I was taking a drink of water.
Yeah, there was a story. I actually didn't read it in detail because it was kind of a weird story. I think it was from like S&P, but apparently CIBC. I saw the headline on my email. They highlighted an uptick in consumer spending after a May slowdown they had seen. So just something. Yeah, I'm sure you could find it if you Googled it.
Yeah, I'll have to. I haven't seen the article in particular, so I won't say anything outside of the anecdotes.
So we have a Fed meeting coming up, July the 26th. Do you guys anticipate the Fed revising the dot plot higher, meaning higher forward guidance? Like, yes, we hiked 25, but in addition to the additional 25 that we've signaled, we're going to go out even further and signal possibly into 2024 that we're going to remain in a tightening cycle.
The market doesn't seem to think so. The market seems to think they're one and done in July and then pause and hold for the rest of the year. I don't know. The market doesn't always get it right, but
yeah, no, I think that's a big risk to the market. Like, people are overly optimistic around the degree to which the Fed is going to remain restrictive.
But that's the point. You're at the wait till it breaks phase now. Because look, go back to January and February, and what were people saying? They were saying, look at yields. How can you buy stocks here? That's what everyone was saying. They were like, look at the risk-free yield. How can you possibly buy stocks here? And yet, a lot of people bought stocks. Okay, and so that's the thing, is people use these fixed, like, comparative metrics. I was even listening to a space earlier today. People were talking about the dollar, and they were like, man, do you think the dollar keeps tumbling from here?
Yes.
And okay, we had no. Okay, that's besides the point. The point is that, like, the short-term movements in stocks have very little to do with short-term movements in the dollar. There is a very loose correlation. You can go back through all of the data for the last 80 years, and over like a 1 month period, there's almost no discernible correlation. In fact, stocks, if you really wanted to put it directly, stocks go up more often while the dollar is going down than they go down with the dollar. So, like, these types of fluid metrics, like the moving price of the dollar, yields which move, pointing at them and saying, like, oh, like, a market rally can't stop, or market rally can't continue in the face of them. That's been consistently proven wrong. And it's actually especially proven wrong if you look at the 3 months before and the 3 months after a market bottom. Okay, the 3 months before and 3 months after. And obviously, you can't know a market bottom while you're in it. We can only look at these things in hindsight. So this is in the last 6 cycles. If you look at the 3 months before and the 3 months after, all the things that happened in the first three months of this year, not all of them, but most of them, the shitty stocks running, the it's only 7 stocks narrative, all these things, that's exactly what gets said every time, because that's what a turning equity market looks like. The garbage that has 30, 40, 50% short interest has to get covered, right? And all of the net positioning has to get grabbed. And where is most of that net positioning getting grabbed? In the biggest names that are the biggest weight components of the biggest indexes. And that's, like, it's all been a flow, like a basic mechanics and flow thing this year. And I think now, if you're a bear, you have to be waiting for something to break. What else can you do now? I mean, you need a catalyst. No one can convince me that equities will go back to the last October's lows without a catalyst.
Why do you need a catalyst?
I mean, what's going to drive a sell-off in equities like that without a catalyst?
Well, let me ask you this question: what drove
Yeah.
the sell-off in the dot-com burst? Right? What was the catalyst for that?
And I will say this really accurately: passive flows have changed markets completely from the .com and even '08. And so by definition,
Term trading has too.
And yeah, so consolidative nature of markets have just been compounding for the last 2 decades, right?
What about commission-free
Yeah, the narrative
trading?
that like markets don't change, like people hate that. Legacy guys hate that because they say like, "Oh, don't say markets don't change because you'll get humbled." Like, yeah, that part is true, but markets do change structurally. That is, I mean, they do,
Isn't the
right?
structural change that and I keep going back to this because people noticed it sort of soon after it happened, but they quit talking about it. I remember it well. It was like 2018. Everyone started. I remember because I heard Charles Schwab talk about doing it. I was at the downtown listening to him talk, and he was like, "Here's why we got rid of commissions," and everyone was like, "Ooh, ah," and everyone did it all at once. It was like Schwab, and it was driven by I think Robinhood. And that totally changed who was investing and how many people were investing. It took a few years, but I think that was a big change. Obviously, COVID amplified it, but it was already going on before then.
No, you're
Yeah,
right.
and
The 3 years, so 2020 and 2021 are the two biggest years for new retail accounts opened ever, and it's like blows it out of the water. Like you're talking about tens of millions of new retail accounts that had no history of the other.
but
Yeah, and
let's
unfortunately,
tie
in
into Nosko's point.
2022, this is an important point. After Stock Talk just mentioned that in 2022, after we saw the historical precedence in opening of accounts, we saw an historical closing of accounts, and 4 out of 5 of these opening accounts were then just closed and saw negative losses and were exposed. Hopefully, they might have re-participated, but we did see a large fraction of retail participants trying to, I guess,
That happens on market pullbacks. Yeah, I mean, people get wiped out, of course. Yeah, but I'm talking about the accessibility, like the ability to access participation in the market has fundamentally changed. It is impossible to argue otherwise. I mean,
But I will say,
30 years ago, you couldn't download an app on your phone and deposit
yeah.
$200 and instantly have access to options
So
contracts.
stock,
That's
there
insane.
was some similar change though, because I remember this. I started. I was very young, and I think I traded my first stock at like age 9 or 10, and it was in the early 2000s, late 90s. And the reason was discount brokers appeared, and I was able to go start, trading with a discount broker that later got bought by TD and then Ameritrade and then TD. But that was a thing that happened back then too, and like I had neighbors who like quit work to become like day traders. They were older, they moved out of the neighborhood. They made so much money, but like that was a thing that happened back then too. And everyone, I remember it, like even as a kid, there'd be like all these commercials on TV for like different mutual funds and stuff, and everyone we knew was like investing in them, and it got to be a big thing. And then of course everyone lost their shirts and kind of like walked away.
Yeah, no, I agree with you. Look, like there are bouts of retail participation that get flushed out. That's always been true, and the data agrees with that position as well. You can go back and look at like, most bull markets have drawn in a bunch of new participants, and the following sell off or bear market or next recession wipes out most of them. That's always been true. I don't disagree with that. But the ability to access the markets has changed. It's different even than it was back then. Anyone can do this. A kid who's 18 can just pull his phone out and download an app, and within a day he has $100 on the app and he's trading options contracts. I mean, that is an insane level of access. That does not have a historical anecdote, right? And that's part of my problem with making like, a lot of times, like even the spaces I do during the day, people will like bring up these points about like, oh well, stock talk had happened before, right? Like, oh, don't you remember the Industrial Revolution, or don't you remember the invention of the internet? And it's like there's always a point in technology where you actually are fundamentally changing the thing rather than just accentuating it. And this is one of those instances, just like AI is, right? But for trading, this is one of those instances where democratization of access and explosion in the availability of different time dated products. Okay, because if you go way back, forget daily contracts. I mean, even weekly contracts are relatively new, and now they're starting to certain market makers are starting to talk about hourly contracts that will be settled on the hour because they know that it'll explode volume.
Yeah,
Right?
this is yeah.
Like,
pure lunacy, right?
yeah,
Like
so that's what I'm
you're
saying. So now
talking.
you're concentrating more and more money into short-term, high-velocity moves. That I mean, Microsoft
Isn't
was
that
up
what caused the
6%
'87
today.
crash, though? It was the rise of options on futures.
Yeah, it might cause a
Yeah.
crash. I'm not saying it won't. Look, I don't believe like I want to be clear. I know I've been generally bullish this year. If you guys heard me on Spaces last year, I was very bearish. Like I'm not a perma bull. I'm just saying like, you know, these things are built to go up. There's a massive global Ponzi scheme of central banks that is endlessly supporting equity markets. There's an explosion in access and democratization of access.
But couldn't you
There's an
argue they're
explosion in
supporting markets right
trading.
now? Can you?
Yeah, I don't think it's the central banking initiative and
No, I'm just
monetary
saying our
policy that
entire
was the
global
issue.
monetary system props up equity markets.
Yeah,
It
I
does.
guess tacitly we know they'll save them, so the downside's limited.
Yeah,
I get what you're
exactly.
saying.
The assurance that equity markets will be saved is a propping up of equity markets. It removes a massive element of like it'll all go to zero risk.
And this is a question that I'm asking specifically, and Bill, because you're very prevailing in monetary policies, this might be more directed towards you, but specifically in the relations to QE and QT, but QE specifically and how it influences market, we know that the majority of the balance sheet is held in fixed income. So essentially, is this like, and this is just me clawing at the potentiality of its connection to markets in the sense of equities by insurances and the abilities to hypothecate this fixed income, and then the abilities for institutional players and other forms of achieving liquidity by the Fed to say then, okay, this liquidity is going to end up eventually within equity markets.
But look, liquidity matters a lot too on the activity of retail traders, right? Like people forget how much volume retail traders really make up, right? They're making up 30 to 40% of the volume. And so what people have kind of skipped over is that when this explosion in short-term trading happened, what it did is it provided the liquidity for fast money funds and institutions to make the moves that would have taken them a quarter to make within a week's time because of the excess liquidity in short-term products. And so now you have fast money fund managers who are directly saying in interviews on CNBC, yeah, we actually never traded 0DT contracts, but this year, like, we've been trading them. Like fast money fund managers with hundreds of millions at their disposal are saying that. That tells you something. Go for it, Bill. Sorry.
No, this is a very interesting discussion. I was listening to a podcast with David Einhorn, right, who's kind of sort of famous for Greenlight Capital value investing. And, he was sort of like sounding like he's giving up on value investing. And part of the reason for that is he thinks that some of the trends that you're talking about, Stock Talk and others, right? Like one, I know David mentions a lot the rise of sort of passive investing, which is these flow driven pools of money that are really sort of price insensitive buyers and sellers in the market. And then the new phenomenon that these kind of very active daily trading of options and other types of securities that again are basically not necessarily fundamentally driven, but just flow and momentum driven. And this actually gets me very excited because I am neither of those two, right? I'm a long-term buy and hold. Like I curl up with a nice 10K and read the footnotes and try to value stuff. But the point that Greenlight made or Einhorn made was he said, like, the problem now is nobody cares. Like, unless you're talking about one of the very big stocks that have a lot of flows and a lot of option volume, if you're buying like a small cap stock and you think, oh my God, this is cheap, it's a 5 PE. He said, in the old days, he would buy it at 5 PE and he'd wait till it was discovered and, go to 10 PE or 11 PE and then he'd sell it. And he says, now it just won't move. It'll stay at 5 PE for a long time. And that's kind of why he's giving up, because I guess he's got performance that he has to deliver. But for me, like, that's exciting because I want markets to be sort of price insensitive buyers and sellers or Momo chasers, right? Because to me, that is for in the way I invest. That's what I want. I want people who aren't interested in the fundamentals, who are strictly interested in flows or momentum. And again, there's multiple ways to make money in the market. I don't begrudge anybody, investing in whatever style makes sense for them, as long as they feel like they can make money doing it. But for me, it means like the competitive field that I have to compete with is shrinking very rapidly, and there's fewer and fewer people who really care about sort of the value of a stock as opposed to sort of what's happening to price. But anyway, that's just my little spiel.
No, you're right. There's more as a result of this. There's more fundamental opportunities out there. Absolutely, I wouldn't doubt that for a second. I think you're spot on with that. But it's people have to kind of rationalize like what a stock is going to do, because at the end of the day, like the vast majority of people who own a stock know very little about it. And that, even to an extent, it's not just retail that I'm saying that about.
Yeah,
Even
there's studies that say that they ask investors, how many of you read sort of the financials of the stocks you own? I think it's like less than 2%.
even better than that, Bill. There was a survey they did of like 12,000 individual stock investors across the United States, and 70% of them couldn't answer the CEO of every company in their portfolio. So it's like,
that's stunning.
Yeah,
that is stunning.
I mean, that's a survey of only how many 10,000 plus investors, whatever they did. I don't know. It wasn't like hundreds of thousands of people, but the
number go up.
Huh?
The number go up.
Whatever, 7,000, 10,000. I don't remember the exact thing. The point is, it was thousands of people. It wasn't hundreds of thousands. But look, the reality is that people are just underwhelmingly ignorant about the companies that they invest in, even on an institutional level to a degree. Not like, I mean, if you have billions and billions of dollars in stock, you have a due diligence team that's done the work. But I mean, there are smaller institutions that are just in stocks because of the narrative. I mean, even if you read the sell side work that most of these tech guys do, which I read every week, it's garbage. I mean, most of it is nonsense, right?
Yeah.
It's just narrative driven stuff. It's just
I remember
it's all TAM driven. I like to call it TAM driven stuff. Like me and
it is all narrative, right? Like I remember being in a space with you. I think it was like a couple of weeks ago, after July 4th. And I think it was when kind of the Sphere sort of first popped up in Las Vegas and started, showing like the basketball or the eye sort of, ball, right? This new venue that's been created. And I think in that space, as you and I were discussing that stock, you sort of more on the, price flow, and me on like, this is really risky because it's losing a piss pot of money and it's got like $1.5 billion of debt. But there were people on that space who were like, wow, that is so cool. And we're buying it sight unseen that day.
Exactly, Bill. And the stock's up another 10%.
Because, hey, look at that giant basketball. Look at that giant basketball on the horizon of Las Vegas.
Yeah, that's what I'm saying, right? It's like it's understanding the psychology. Like the first trade I guess I ever made was back in 2012 when I was 18 and I bought Adobe, right? And I sold it in 2016, and I was like, oh, it was a hell of a trade. I'd like almost tripled my money, and I was like, all right, sweet, like I'm out. And then because I felt the stock was getting rich, I was like, oh, it's getting rich. And then the stock proceeded to rip into 2017, 2018, 2019, 2020. And I was kind of like, oh, wow, like, fuck me. And then, 2015, 2016, I bought Tesla, which was really like the career, I guess, I don't know, I call it career defining, but portfolio defining certainly move for me in 2015, 2016. And that was not a fundamental thesis at all. I bought that stock because I felt like electric vehicle adoption was going to increase. And I felt like they were the only player at the time. It was that simple. It wasn't because I looked at Tesla's balance sheet and thought it was, a beautiful balance sheet, and I think that's the difference is like sometimes people adopt to a strategy that works for them and they kind of put aside the more traditional way that they were taught. And that's kind of how my trading adopted. Like I've gotten shorter and shorter term in my thinking because I've realized stocks are so narrative driven and that so quickly narratives can change, even if the fundamental story doesn't change. And so I still have stocks I invest in. Like, I have stocks that, like I've talked about these lithium stocks for years now. I'm invested in those stocks. I plan to hold those stocks for 10 years. That's that's a entirely different lens than I view the way I look at my trading portfolio, right? Which is entirely like, hey, where can I squeeze out alpha that I know is a place that, I can get it consistently. And that's really all that matters for the trading account.
You just got a message on your Discord there, Stock.
You knew that was a Discord notification? I thought you heard Leo squeaking this toy beside me, but it actually...
Oh, is that what that squeaking is? Or that is your chair?
I mean, he is squeaking a toy. He's like right beside me.
Yeah, Weimar, go ahead. Tell us why they're wrong.
Oh, no, I wasn't going to argue they're wrong. But I was going to say first I put the CIBC thing I saw on the Nest. Not a very good source, but it's an interesting headline, so I'll have to research it more. But the thing I wanted to say was, to David's point, the rotation between bonds and stocks isn't as easy as people think. A lot of times, the bond investors have to be there for a variety of reasons. It could be fund prospectuses. They have to meet certain yield requirements to meet cash flows if they're a pension fund. They may just be precluded. A lot of, like banks obviously couldn't buy stocks, but we do buy treasuries and we buy MBS. So there's all these different things there, in addition to central banks, which often, don't buy stocks, with the exception of the Swiss central bank. So that was what I wanted to say there. But then I was going to go on and say, what our market reminds me of a lot right now? And I wasn't terribly bearish until recently, till the bank thing started. But it reminds me of the Chinese stock market after 2015, 2014, 2015. You'd have these tremendous rips and they would push liquidity back in and it would go back up, and then it would have these tremendous crashes. But it was like the central government was almost driving the stock market as a means of meeting economic goals. It's kind of interesting to study. I remember we used to see the news stories back then, but it would go in and out, and they'd be like, "Oh, China's done now," the stock market just tanked, but then it would come ripping back. It would be like a year later, and it would be back on top. And that's kind of what's happening right now reminds me of a little bit.
And Bill, go ahead.
No. Go ahead.
And I think to that point, right, it's more leaning on stock. And Bill, your conversation, security analysis is a complicated endeavor, one, and the majority of the market, and Bill, you mentioned, I've been ringing the bell maybe too much on passive flows, but these passive flows, right, that's 43% of all market participation, 73% of all market flows that we saw, and market inflows was in the last 6 months, was actually the proponents to why we saw market uptick, in the sense of its consolidative nature and the actual propensity of the markets to go up within this 6-month period. But long story short, these buyers don't know how to read an income statement or a balance sheet, and so by definition they have no ideas of any fundamentals. They are not fundamental buyers, just by definition of their delegations of passive investments to passive structures and passive vessels, right? They delegate their responsibilities immediately.
Right, which is fine, right? Especially if all you're doing is sort of just index the ETF or whatever you're investing in is sort of very low expense and mirroring sort of an indice. I think that's fine for most people, right? Because you're just getting exposure to U.S. equities over the long term is a winning proposition. I just don't know where the tipping point is, right? I'm not completely bought into that passive flows are a menace to markets, but there's no doubt that they are price insensitive buyers and sellers at certain times when flows are either coming in or
at most times.
Yeah.
But I have a question.
So to me, that's an advantage for me, because again, I'm I'm looking at the value, not the price. And if I have the cash and some particular stock is being beaten up, the only difference I've noticed, in my time investing, which I've been investing probably since I guess early aughts, is there is definitely, if you're not in certain stocks that have a lot of action, quote unquote, nothing happens for a long time, no matter how good the story is, right? They just sit there. I mean, it is what it is. And if you're willing to just say, well, as long as the business is operating the way I like, and the management is making the right decisions in terms of allocating the cash flows that are coming in, and they're not doing stupid stuff, I'll just wait. And eventually, typically what happens is either an event happens, or just you just can't predict these things. All of a sudden the stock just starts moving.
Or you wait for the catalyst, and that's when you trade it, which is what I did.
Yeah. No, that fear is cool, and people bought it and it went up 10-15%, right? Who am I to argue that YOLO doesn't work sometimes?
No. I'm not saying YOLO works. I'm saying, but look, but not all short-term trading is YOLO, Bill. That's kind of my point. Is there's this perception that everyone loses money day trading. It's because people have this pigeonholed perception of what short-term trading is. They think it's it has to be based on some random 50-50 system, and it absolutely does not. I spent.
Yeah, that's fair. Sorry, I didn't mean to criticize.
No.
I don't know anything about this.
No, look, hey, Bill, you and me have conversations like this all the time. I don't take it personally at all. I really am advocating for the idea that, look, there are people that are successful traders, of course, but it's this idea that like all short-term trading looks the same. Like all short-term trading is 0 DTE contracts, slapping it, YOLO, maybe it'll go up, right? Like, for example, like, I mean, the people that know how I trade in a very focused way where every week I look at hundreds of news stories, I go through SEC filings, I go through pretty much every sell side research report, and I decide a handful of stocks. And I mean, Patrick's there all the time. Sometimes I don't even pick a stock. Sometimes I'm like, there's nothing, like there's nothing that I like here that I think will move a stock. And I go through hundreds of tickers and pick a handful of stocks that I think have a reason to move, whether it's intraday, intra-week, intra-month, and I make those picks selected on that. So it's not even really an objectively data-driven process the way that technical trading is, right? Even technical trading, you can make the argument that a lot of technical trading strategies have a 50-50 outcome in either direction. And a lot of them do. Some are slightly better than that, some are slightly worse. But catalyst-driven trading on an execution basis has the ability to have a much higher hit rate than that. And that's the difference, is like it's entirely subjective. It's based on me going through reports and saying, yeah, that's going to move the stock, or no, that's like a meaningless noisy report I can throw in the garbage. No one's going to take this opinion seriously. Citigroup raised their price target by
hold
$2.
on, Stock.
Yeah.
I have a question. So let's just say you woke up, it was like 2020, and you read this article, Hertz rental company is filing for bankruptcy. Do you think, oh, this is very bullish, I should buy some stock?
No, but see, that's the point. I don't catch every opportunity, and I don't pretend that I do. Like that's the thing. That's fine. Okay, I missed the Hertz trade. Like I missed, for example, this year.
But
That's not the point I was trying to make. That's not the
I think
point.
that's his
Yeah.
point.
No,
How
but
would you
I'm
ever
saying, like,
know that?
even this year, like somebody was criticizing me for like missing the Coinbase trade, right? Like, okay, so what? I missed the Coinbase
Dude,
this year.
Hertz was
Like,
retarded. You have to acknowledge that was the opposite of what you
I
think.
agree. Look,
But how would you
Carvana was
spot
retarded
that?
this
That's
year.
just like, that just shows you things are stupid.
I agree. No. Look, I agree. There are stocks that run for stupid reasons that I don't spot and that I don't catch. I'm not saying that I catch all these. I didn't catch Carvana this year. It's up 500% year to date, right? Like, I'm not saying that I catch all these. I'm saying the stocks that I do trade genuinely have really good quality catalysts, and they generally move. Like,
Well, we're not
I'm not
criticizing you didn't catch it. You'd be stupid if you had caught it.
that's not my point either. I was
Yeah.
just saying, like, to Nostra, like, when Nostra brought that up, I was just saying, like, that's the point, is, yeah, that's fine. I'll miss some Hertzes and some Carvanas because they don't fit quality catalyst material. But the trades that I do catch are meaningful. I mean, people act like sell-side research inflections don't move stocks. Yesterday was the biggest ever day for solar stocks, and it was driven all by a Morgan Stanley report in the morning.
So you
Right?
know when the last
So
time that was? There was I used to work at Sell-Side Research for a year as
And sorry, I said biggest ever. I meant biggest year.
Oh yeah.
Sorry, not big.
Well, I was just gonna say the last time that Sell-Side Research really mattered was literally in the late '90s, early 2000s, and that's when they cracked down on the whole sector. There's a book about it by Charlie Gasparino called Blood on the Streets, and they went after it because a lot of these guys were pushing these stocks, but the retail investors would hear things got a buy rating and they would just run into them.
No, yeah, and it doesn't work like that anymore, where it's just blind. But there's still
that was also before Reg FD, right?
Yeah, Elliot Spitzer reformed the whole thing and put up the quote Chinese wall and a bunch of other stuff.
Right, the Chinese wall, yeah. And look, I'm not implying that like anytime somebody sees a buy upgrade, they should buy the stock. In fact, that's the opposite of what I'm saying. I'm saying, and by the way, it's not just sell-side research, but on the point of sell-side research, like I can point to you literally 100+ examples in the last year alone where an entire sector or a stock had a meaningful move, and the inflection point was a pivot in sell-side research. It's not because what they're saying is true, or that their opinion is groundbreaking, or that the analysis is like magical. No, it's just that some banks have the ability to influence opinion in other sectors better than other banks do. And very often when you have a stock that has had no sell-side opinion in 6 months, and Morgan Stanley shows up with 80% upside targets, the stock's going to move. That is a high probability outcome to bet on. That's not like the chances that you buy a solar name the day Morgan Stanley upgrades it with 110% upside and the stock drops 10% intraday is extremely low. Extremely low. What's most likely going to happen is going to go up, and you're going to wonder how much it's going to go up. And that's the harder part of that equation. And it's like, and I'm not saying buy every Morgan Stanley upgrade either, right? It depends. Okay, what does the coverage look like in the last few months? Is the sector hot? Does the volume look good on these charts? Are the charts setups themselves technically ready for a breakout? All of these things matter to make this coherent opinion to say, yeah, the stock's worth trading based on this catalyst. And it, again, doesn't have to be sell side. It can be news. It can be a tidbit detail in an SEC filing. It can be any of these things, an offering above the share price that nobody hears about or nobody understands. Headline-driven sell-offs where people don't read the article. There are catalysts of all sorts that you can make a quality distinction on. But I don't just blindly slap zero DTEs and just YOLO stuff. No, it's a refined process.
Wait, you don't like money?
Huh?
You don't like money?
No, I mean, look, there are a handful of times I've traded zero DTs, right? But there are times where I trade much further dated contracts and do very well. Like my IonQ position, those are 2025 contracts. They're up 300%. It's like I actually rarely trade zero DT. I might occasionally trade weeklies. Like last week, I traded a lot of weeklies because the market was ripping hot and I was just striking while the iron was hot. But most weeks I'll trade months out expirations to get controlled exposure to a catalyst. Because again, I'm rarely buying stocks for fundamental reasons unless I'm investing in them, like the lithium stocks that I always talk about. Those are investments. That's an entirely different case, But outside of my investments, I don't care. I don't care if the stock 6 months from now is going to be 50% lower. Like the same thing with Sphere Entertainment. Like I didn't give a shit about that. I just knew they launched in Vegas. The 4 weeks later, London 1-1, Dubai.
But those videos were so cool.
No, it's not even the videos were cool. It's just that there was an enormous amount of marketing hype. There was a direct catalyst. There was
one guy literally on our Space Stock Talk that hadn't seen it. Somebody flipped him the videos from Twitter.
I remember that. Yeah, that was stupid.
Oh, that's so good. I'm gonna buy the stock.
Yeah, that was stupid. I remember that. Okay,
didn't Peter Lynch have a famous saying where you do a lot of research on what microwave to buy, but when it comes to your entire network, you just take a random tip from some guy on a bus or whatever it is. It's like, yeah, put all your money into this one. It's like, oh, Sphere, cool. I'm putting all my life savings in it.
YOLO, awesome. Yeah, that's right. But that was funny.
I just think there's controlled forms of short-term trading that I think if people have the time, then that's the number one thing, is it takes a lot of time. But I think there are controlled forms of short-term trading that can be consistent. I really do believe that. But it takes a lot of work. I'm not pretending that it doesn't take a lot of work. It takes a lot of work, and it takes a little bit of subjective skill too, the ability to differentiate those things and, market experience to know when a call is bullshit or if an analyst is raising a price target just because the stock went up, right? Like those things are hard to spot and that takes experience. I'm not pretending that it doesn't, but I don't know. I mean, my opinion on short-term trading used to be very much like most people's is that like it's just gambling and it's stupid. And I went through a bunch of strategies. Like, man, when I first started, like when I was 18, 19, I was doing like OTC stocks back then. And like I tried everything. I went OTC stocks. I did options only. I did large caps. I did small caps. I tried to be a fundamental investor for 3 years. I tried all of these things. And I just eventually settled on the thing that worked consistently for me. And I think it varies from person to person, but I think everyone should just find a style that works for them. If you make money, that is the ultimate barometer, I think. If you are earning money consistently, whether you're investing for 25 years or whether you're trading over a weekly or monthly time frame, if you're making money consistently, then I think you're good, right? Like, I mean, the S&P 500 is up 10% in the past 3 months. My portfolio is up 76%. So I'll take that outperformance. Like, for me, that's worth the time I put in to actively trade, So, yeah. That's my 2 cents.
Weimar, what you got?
So, one of the things that I started to notice in 2021, and in fact, at the time, B of A's economist was at my work talking, so we always have people in. And I asked him about this. I was like, what do you think of the retirements right now? Because stock returns have been so good. And he's like, actually, that's something we're researching right now. And he started to talk about that, how that's starting to be a problem, and it was driving down some of the labor force.
So a lot of that, more like my dad retired. He retired 5 years early because his stocks were ahead of time. I think he was like 57, and he was planning on retiring, I think, at 62. So he retired 5 years early. A bunch of people at my work retired up to a decade early in some cases, at the bank I worked at, and it was a big driver of some of the labor shortages we were seeing, and it was purely driven by the fact that stocks went up 25% in 2019, and then in 2020 they went up over 20%, and then they went up over 20% again. So these people are sitting on these just monster gains that put them years ahead of where they needed to be to retire. And you can see this actually in the data now. There were a lot of excess retirements for some of those older cohorts. And I wonder if the Fed isn't thinking about that as they consider whether to hike once, twice, three times, etc. In fact, I think Yellen today mentioned that she wouldn't put too much stock in the CPI number right now. So I found that kind of interesting.
David,
Meaning
why
what?
would she say something
Meaning
like
what,
that?
Weimar? That they're going to try to crash the stock market to get people back to work?
Not to get people back to work, but to calm retirements. You've got to imagine if stocks go back up to where they were and just keep rising, well, they're still going to be 60% ahead of where they were 3 or 4 years ago. So if you had $1 million account, it's worth 1.6 million or whatever it is. And just if you were all long equities, which many are now, many people are all in equities.
And how much do you think of these retirements actually liquidating 100% lump sum? But most of the time, and this is just anecdotally that I've been seeing, it's very one within the beneficiary claims that the actual retiree is going to have. And so by virtue, we actually just see a net, let's say, actually, depending on the inflows versus the outflows of the actual pension structure that's occurring, we see a net negative response towards the actual inflows in that sense. It's a non-matter in that sense, specifically in the amount of retirees that we're seeing. It's only if we see the actual increase in retirees, this is where we see compressions within pension fund solvency, not liquidity, but solvency.
Yeah, and one other thing I'll say, I've encountered quite a few people on Spaces who used to work, but now they're full-time traders. I don't know how big of a trend that is, but I certainly saw a lot of it in crypto.
Most of the people I know that have done that have gotten wiped out. I mean, for me, when I became a full-time trader is when I left med school, and I kind of didn't have a choice. My back was against the wall, and I kind of had to make money. But I think a lot of the people who started during 2020, like with stimulus money or whatever, they've gotten wiped out. Like I remember in 2020, a lot of the accounts that were around here aren't even here anymore.
But will they come back now?
I mean, maybe in the next stimulus.
To our prior statement, when Stock Talk mentioned that we saw a historical opening of accounts throughout 2020 to 2021, in 2022, after we saw a massive compression, we saw the actual same historical closing of these accounts. I just wanted to ring that bell. But again, Bill, I think, is accurate when he mentioned this is why we see this passive evolution within markets, because most of the time, most people don't have the competencies and or wills to understand the nuances of market participation, as Talk does it, right? And so by definition, they're much more inclined to say, I'm going to master my work and my field and my career and allow my financial development to be delegated towards, let's say, hopefully a fiduciary responsible entity. And now comes the question of fiduciary responsibilities in that sense and how we actually appropriately manage these flows, right? Especially considering and this is a big idea, right? The lack of fundamental developments. As long as money is coming in, I am a net buyer. And if the money wants to come out, I am a net seller, non-implicit of, let's say, indexed fundamentals. And so that's actually impactful in other ways. But I don't think it's as dangerous as a lot of the prevailing thinkers would think. And a lot of, let's say, the aggressions that we were seeing around it, I think it was over-aggression because by definition, we've only been seeing an apathetic development. My argument is the only time this becomes an important factor is when we see ex-retirees higher than the net inflows of these actual pension structures and insurance structures, and then creating an actual solvency crunch. And then when that manifests into a liquidity crunch in the sense of market participation, that's only a given time bomb.
Well, ask a question where is this money coming from? Because you talk about liquidity, right? The liquidity is going up, right? So the M2 supply, money supply going down, the credit crunch, hard to get loan approved, right? And I don't know, the last report from the BAC, Bank of America, they said they only have 2% commercial like real estate loans. They said they're safe. So what make it confusing? Like it's not like Fed doing QT right now. Where is the money coming from? The liquidity is so confusing. I still don't get it.
It's 401ks, and the
Well,
Fed
Bill can
balance
tell you
sheet.
too.
The Fed balance sheet is essentially net negative, because essentially they're only receiving the inflows from the BTFP, and like obviously when we're looking at the attractions that we were supposed to be having, it's not as severe, but we're still seeing the Soma balance sheet slightly lower than the actual January lows that we saw at the earlier 6 months. Weimar, sorry for interrupting you.
No, I'll just say what I know Bill's going to say. A lot of it's coming from the reverse repo facility, and that's 100% true. One of the things that happened in 2022, we were still doing QE, but it was all being sterilized at the reverse repo facility because they didn't want money market fund rates going negative for the prime government funds. So they were basically letting them park money at the Fed at 5 bips, as well as some other participants. And what that did is it eventually filled up to, give or take 2 trillion. Recently it went over. Well, now it's been running down. So a lot of the net liquidity that's been flowing into the market is from that. But a lot of it is just the stock market is a little bit detached from, say, banks and bonds and all that type of stuff now. So it's almost like a different pool. But on net, that's where it's coming from. I'll caveat that, though, and say there's 83 billion a month coming out still in the form of QT that the Fed's doing. So a bit of a give and take there.
I think it's also risk. I think it's also risk appetite, right, is increasing. Like I think what happened towards late 2022 was there was still a lot of money sloshing around from fiscal stimulus and the pandemic, but people were scared in 2022, right? Any space you came onto here, like it was, the bears were growling pretty severely, and so I think a lot of people went into T-bills or bonds for safety, right? Thinking the market was going to crash, and then when the market didn't crash, like what ends up happening, right? It's like my favorite sort of anecdote about this is the way Buffett describes it, right? When people have fear, it's like somebody yelling fire in a crowded theater, right? Everybody rushes out immediately. But then when there is no fire, it's not like everybody rushes back in. It's like they start coming in 2 and 3 at a time. And that's what's happening, right? Since basically October, it's like nobody believed the market was going to go higher. Everybody was worried that, the Fed was going to, crash the economy into a recession. So everybody got kind of scared and went into sort of quote unquote safe assets. And now 2 and 3 at a time since like October of last year, they're coming back into the market because they see prices going higher. Now, is that, is the market undervalued or overvalued? I don't know. It doesn't feel undervalued anymore. It certainly felt undervalued last October, but I think it's just risk appetite. I think the money was always there. It's just now coming into stocks because people feel the all clear signal's been given.
Such a
Thank you
really
for the answer. And yeah, just like also like I think the equity, what they say that the QE may be coming, right? They might think like, oh, it's like Fed cut coming, maybe the QE will coming soon. Right? And if you talk about the Fed balance sheet, right? It's not like go lower than 2020. It was like 2 trillion. Now it's like what, 8? It's supposed to be like last year like 9. So maybe go higher to 15. I don't know. They might keep doing the QE. That's why the equity market, maybe they see that in 2024 or 2025, maybe they just why keep buying now. I don't know. That's kind of like my kind of like opinion.
Yeah, again, and that was a question I had for Bill, and because I think it's infinitely more complicated how actually QE and QT is stimulative or counter-stimulative towards market participation, especially when we're considering the majority of that balance sheet being fixed income. And so by definition, how it's getting distilled to the equity market is fairly nuanced and complicated, and I think it's still going to be revised and let's say reviewed for a longer term period, because we still don't have conclusive ideas as to how exactly it's been implicated. Money, I saw you unmuted, and then Deep, we have your hand up. So Money, go ahead, and then Deep.
Yeah, no, I appreciate that. Really great commentary, but I would like to inject something else from another perspective, that you have money chasing tail right now, not retail. And that's what I think most of us are used to, that you see that there's like a retail influx. But there have been a lot of people sitting on the sidelines, and so there ain't no money, like big money, chasing some tail. So when you look at what's moving, and it's a lot of this shit stuff, there's been positioning already kind of early on, but why? Because you're able to actually get that beta, like you're able to get that percentage gain, you're able to get that stuff. And Carvana will always be a shit company, but at the same time, you have to kind of stop thinking. And sometimes some of that could be what gets in your way of just like where there's a technical setup. And I think that's a lot of what we're seeing right now is just a big chase into I have to get exposure. And how do you think like most people will get exposure? Um, Going with something that can short squeeze like UPST, because if you've looked at that one, there's been a ton of dark pool activity. There's been some options flow, like millions, which is so unusual for that name because it really is a shit company. Like end of the day, that's not where you want to invest. But if you're looking to kind of just turn some revenue, you're going to find that. I want to go back to what Stock Talk was talking about because I joined a little bit late, but got on the tail end of the solar names, and that's been on my radar ahead of any kind of analyst update because we had some options flow come into TAN, and TAN is a solar ETF, and you don't see a lot there, and so there was already a little bit of a tension there, and it was way out of the money. They're positioned for 721.76 calls. Those went way underwater, and they started coming back into 818.75 calls. But what was so interesting and such a dichotomy was that TAN saw great money flow. None of the individual names did, and they weren't moving. So once you start to see where you get positioning come through there, because an ETF isn't going to move just because it's an ETF and somebody like lights a fire in their ass. It's going to move because individual stocks are going to move. So you do want to kind of pay attention to where you have some of that possible rotation, and that's one of the things that like I really love, and I love to be able to focus on is like, hey, here this is extremely beat up, and we've got stuff over here, and it kind of can give you some of that early entry or at least a heads up to make sure that you're setting alerts for breakouts. If you're a technical trader, I don't want you to trade like me. We're not all going to be the same. We're going to be looking at different things. Some people are fundamental, technical. I like money flow. So it's all going to be different, but at least you kind of have a little bit of insight to where you're starting to see some sector rotation. And if anything, that's what I love most because it gives you a whole basket of stocks to work off of, and you get to kind of go through charts, find your setups, find what works for you and your personal trading style, and then kind of go from there. And I appreciate the kind words. Thank you, David.
Yeah, question a bit for the money flow. Like, how do you know is that one a part of the hedge? What if, let's say, like a call or like put, right? What if actually that actual position is like short, but they just by call just want to like for short term, right? How do you know it's like a bullish for, or could be like, I don't know, could be opposite?
Yeah, no, I mean, like, absolutely. You can certainly see that. And I wouldn't know that. There's nothing that's going to tell me that. But I'm kind of a meshed trader in the sense that I'm looking not only at the flow that comes in, as soon as I see flow come in, I go to the chart and then look that up and kind of get a feel for, what's coming in. And if it fits my criteria, it does. Like I want to see that coming in at an area of support, not something that's overextended. There's nothing that's going to tell me that, but at the same time, I like to use a lot of layering, meaning, if I see XBI call flow come in, and then all of a sudden I see LABU, and that's a 3 times triple leverage long XBI, that gives me that other adage to go, okay, well, like there's some serious conviction coming in. Doesn't mean it's the same person. It doesn't mean it's the same house or anything like that. But if I can start to layer different things that are just kind of really checking off some boxes, I feel a lot more confident with, that trade.
Yeah, one thing I'll add is I'm not like a flow-centric trader, but I do look at flow on most of the stocks that I trade just as a point of confluence. And invest, to your point, it's part of the reason why like index flow is so useless. Like when I see people posting like QQQ or SPY flow, it's useless because there's so much flow on those names that you can't possibly know if somebody is hedging an equity position in shares of those names or if somebody is taking a bi-directional bet. It's just way too much. And so where I personally focus, or where I think it's meaningful, is on names that typically don't see options activity. So on names where you know that there is not normally options activity, you can say, whoa, that's weird. Somebody's taking a $2.5 million one leg unidirectional bet on a stock that never sees options flow. That could be significant. And if it's a stock you're already looking at because the chart looks nice and there's a catalyst, and then you see that type of confirmatory flow, then it just adds conviction to your position, right? Like this happens all the time. Like, when we're trading, like with TSDR, who's in our community, he'll like a chart sometimes, and then I'll wake up in the morning and be doing my catalyst research, and I'll go, dude, that chart you were looking at, it has a catalyst too. And then, one, or maybe our new flow guy or one of us will go check the flow and say, and the flow has had crazy millions of dollars of inflow too. Like that's confluence. That's just adding data to your decision, right? Trading is just a game of like taking data and making a decision. That's all it is.
I
And
agree.
so,
I agree. I
you know,
definitely feel
yeah.
like a Microsoft, like you said today, right? Kind of like couple seconds before the news, like the call, like 344 is jump like $20, right? I mean, but again, like for the big companies, it's very hard because like so many like flow, like call put. It's not like a small, like you said, like small company, right?
Yes.
For the bigger company, I feel like harder, right? Like Tesla, Microsoft,
Yes.
Nvidia, right?
You are on every part of what, like, I actually exclude all of that flow in the mega caps because there really isn't, for me personally, an edge because they are the most heavily traded. Even from a stock perspective, you will be chasing tail trying to find out up, down, up, down, up, down, because what most people don't even take into consideration is that they are just traded. So you can come into some calls in the morning, you get a $1, $2 pop, you're closing them at 11 o'clock in the morning. And none of that actually settles or stays in open interest. And I'm really with like Stock Talk, and I like that he brought that up. It's that unusual stuff because let's like really take a look at this market and kind of where it's been different in a lot of ways, where when we had down days before, everything was red. You can have SPY down and you can have a grid of charts, if you're like that good, that are all green. It's okay. Like it's an individual name game at this point. And some of these are still running despite what the overall market is doing or despite what their individual index is doing. So I don't look at, I'll still definitely take note of kind of what's coming in, but I don't trade. Those are not the names I trade. Like I want somebody to come light up BJ in some calls because you never see that. And it's going to have a reaction because it's so rare, and especially because of so many growth names that we have coming through. Like IWM is set up.
Well, money. One thing, if I could just interject for a second, is just
Sure.
the implied correlations are like at all-time lows right now. So correlation is just how those stocks move together, and we're looking at the lowest implied correlation since before the global financial crisis. So that's why it's been like a wider level of dispersion.
Stock pickers market.
It's been a stock pickers market. I think personally, just my own opinion, I think that the drainage of the reverse repo facility and the movement of those flows into money market funds, which are then buying treasuries and then lending that cash to broker dealers, at a longer term to maturity and at much more favorable borrow rates, is, I think, like the most significant aspect of the market right now.
Well, I like what the stock talk news about and money flow as well, right? Like today the Microsoft about the news, that's very good. And what do you think the correlation make it like detached, like the fixed correlation yield, like bond, stock. What do you think kind of like out of the textbook? What do you think like this, why it happened? Like the correlation and everything, right? I thought like we know like sometimes, but let's say when the AMD like NVIDIA, AMD, right?
I mean, it's just another way to reduce your risk, right? Like most of the time in a recession, correlations go to 1. Everything moves in tandem. So if you have, certain parts of the index which are going up, like Money was saying, you have certain parts of the index which are going down, you have wider dispersion, and it reduces your overall risk of your portfolio, and it suppresses volatility.
Yeah, and on the point that you were making earlier, and this isn't related to correlation, but invest to kind of simplify what Money Flow was saying about, you were talking about, hey, on Tesla and Apple and stuff, like the flow is impossible to discern. That's the same issue as I was highlighting in the indexes, because it's because of liquidity. So generally speaking, the more liquid an options chain, the less readable it is. That's like a very good rule of thumb. So if you have, tens of thousands of OI on every contract on the chain, you're not going to be able to tell your foot from your head. Like it's, there's way too much flow. And so where it's material is where the chains are dead. Okay, where you're going to like a November strike and it has 0 OI, 0 OI, 0 OI, and then all of a sudden $5 out of the money, there's $10 million of open of OI. Or not, but you can make a pretty decent assumption that someone is taking a directional bet in those cases. And a lot of times, because if it is really meaningful, it's too big of a position to be used as a hedge, or it's too far out of the money to be used as effective hedge. So you can kind of like sort through the data and make that conclusion. But for me, the only times I really ever pay attention to it is on the mid cap names that have options chains that are not active options chains. That's
you're
where
gonna
I
get some
found the
movers.
most.
You are going to get some movers.
Like a handful of these, like from the last few weeks trades that we took. Like, yeah, go for it, Darren. Sorry.
So tape, they know that you can see it, right? Because it's held overnight. That's risk that's being held overnight. Volumes, intraday that are opened and closed, like Money saying, where it doesn't even show up in the open interest because they're buying or selling, within a matter of minutes, hours, or before settlement at the end of the day. So
yeah, it's not always OI. It can be volume driven too, right?
Yeah. But keep in mind, if you are only looking at open interest, and I'm not assuming that you do, I'm just saying, for the group, for education, if you're seeing open interest hit the tape in the options market, they know that you know that. And so, either they're okay.
Real-time volume is much more meaningful. I agree. Yeah, real-time volume flow into the contracts is more meaningful, and that's why most of the people that alert real-time volume flow as well. But the point is really just that you use it as a tool of confluence, right? Like for me, I just use it as a supplementary data point. So like if I already like the chart, I already like the stock, it's a great catalyst, and the flow is good. Cool. That's another checkbox, right? Like, and just gives me more conviction. So that's really what it is for me.
I totally agree, but
so what I want to say is in terms of the biggest dollar amount impact, like over the last 90 days, we've seen $592 billion get drained out of the reverse repo facility. So I mean, we can talk about other dollar amounts like in Tesla, options land, but in terms of it, just like the total dollar amount that's had the biggest impact on the market, in my opinion, over the next 90 days. And I think outside of like foreign FX reserve flows, like that's like the largest dollar amount that I think is propping this market up, which is a liquidity driven market.
Yeah, question for Darren. Like, I mean, like, if let's say they know the flows, like we use it like they know we will buy. So I mean, like it's not like going to help them to support like their trade, right? Because like if they buy, we buy, they will get even higher option because they're the one who bought first, right? I mean, like is that
Who
anything
are you
bad?
saying they? When you say they, who do you mean?
I mean, like no, you just said like they know the flow, right? You said like you talk about the big players, right? Like the institutional, they put the bet, let's say they buy call, and we know we follow them. So and you basically say, and in my assumption, you seems like say like it's not good to. They know that, and they might mess up with us, right? They might do something bad to us. Maybe they sell before they, maybe when they buy, we buy, they sell it, so they can just like take the liquidity, right? So is that something bad? Not really, right? If we buy, we follow them, then it just keep increasing the option. They also make more money. We also make more money too, right? Is it like something bad if they know we follow them?
No, I'm not saying that it's like a negative connotation one way or the other. I think it's just if you know that they know that you can see their, open interest that's hitting the tape, and not everybody that's trading options is getting intraday volumes printed. They could have the appearance of one type of positioning when in reality, based off of how they're trading it throughout the day, it could be completely different.
Yeah, you get to see the flop. You get to see the flop, and how you position around that is going to be different. And a lot of what I like to do is absolutely continue to check open interest, and I think that's something that retail doesn't do enough of. That's really, really important, because when we're talking about, or if you're ever seeing anything, and I don't care who you use, what you use, whatever, you can see a large order come in, and let's say off of that large order, just because there's that interest, you have a stock pop up 1, 2, or if you're Microsoft, $1 gazillion today, they could be closing that out, and it never settles the next day. So I don't like. I'm not on here to advocate or to promote. The options flow is the best tool, and I think Stock Talk said that the best way. You have to find your edge, like something you can read, something you can understand, something that makes sense to you. Um, don't just follow what makes sense to everybody else, because you may not have full understanding there. And I just really want to kind of like hone in on that a little bit, just because this is what I sit with all the time. This is like I'm really good at this. I don't expect everybody else to be, and you may not see it the same way, and I don't mean that from an arrogant perspective, but there's little things that you're going to be able to pick up on and read, but you have to be able to monitor that other stuff. If they come in, they could also ask exit. Are you able to see that they exited? Are you looking for that? And I think that's probably one of the biggest things that most people don't do, is even monitor that. So really, really important. Monitor OI.
I totally agree with that. Yeah, and then I usually what I do, like I see the news, like what the stock says, I would just go for it. I mean, because sometimes like you don't have time. It's just like 10 seconds. Sometimes they just put like literally like 1 minute before the news, and it's just like going up so high. So I mean, I agree with that. I mean, like about the OI, like the open interest, like you said, there's definitely need to pay more attention to. But yeah, many times I feel like I don't have like not time, but it's kind of like too late. If I if I want to get more confirmation, it's just like going high like within a minute, like 1-2 minutes, like when the news like Microsoft today, right?
Yeah. Well, Deep's been waiting here for a little bit. We'll let him get his question in, and then I think that'll be the last one, and then we'll wrap it up here.
Yeah, no, very interesting conversation. I was listening for like the last 30 odd minutes. Look, I think this is a very, very interesting time in human history, because I remember around the same time last year, everyone was in, this extreme kind of fear stage. Many people were thinking that we could see 3,200 or 3,000 on the S&P, and there were no buyers, and there was a lot of panic selling that was going on, and short sellers were literally getting some of them just printing millions of dollars in a week. Some of them that I know in the industry, it's insane how the tides have turned. The tides have turned for the better, because I do believe that over time, equity indexes do appreciate, and generally speaking, if you're not someone who's a regular market participant or kind of doing this for a living, most people should generally, go long the market over time. Sometimes, right, you can catch a bad company and short it and make a lot of money from it if you time the exit. But generally speaking, good companies do appreciate over time, and good management teams do reward their shareholders. So, just some kudos to retail. I do want to say though, I would.
I would push back a little bit though. I would push back a little bit. And one of the things I'd push back on is we had to undergo a regional banking crisis, right? Where there was collateral damage that happened, and the Federal Reserve stepped in, and, it hasn't been like, great, like everything is, hunky dory. I think there's been significant steps that have been taken to mitigate the actual risk that's in the market, and it still hasn't, it's
I'd
just
have to
been
push
kicked down
back.
the road. So Silicon Valley Bank going under and First Republic going under is what? So that was a non-risk event, like that?
No, I mean, you hear me out. Look, I'm not saying that the Fed hasn't injected liquidity into the banks, because they certainly have. What I'm saying is that I think it's a bit too premature to say that there's no real risk to equities in the second half of the year or even into next year. I think a lot of people, right, are in this kind of euphoria stage of extreme greed. And at least in my lifetime, I've seen extreme greed get punished, and punished hard. I'm not saying that the market's going to sell off to October lows tomorrow or next week or even 6 months from now. We could have a soft landing, and we can continue this rally, and multiples could continue to expand well beyond all-time highs, right? I'm open to that possibility. But it's kind of interesting how there's so much fear of missing out right now, while fundamentals, in my honest, humble opinion, just don't really match up. And I think we'll start to see. I mean, we're already starting to see it, right? I mean, a lot of these companies, they have already posted their earnings. They have had record quarters, but the stocks have been starting to sell off because a lot of investors just don't see multiples expanding from here, especially in very high quality names. You saw that with Delta. You saw that with Lockheed Martin today. Tomorrow we're going to get Goldman in the morning, which is projected to report its worst ever quarter, which is a very, very important bank on the street. We'll get big tech next week, and the week after that as well, series of big tech companies. Microsoft is at an all-time high. Can multiples expand for these companies beyond their all-time highs or even 52-week highs that they keep on making? Sure. I mean, I'm not kind of someone who's going to say, just short the shit out of everything. But I do think that there's a real risk of valuations kind of appreciating further from here. There are companies that are undervalued, and you can find some great alpha from there. But I tend to be more cautious from here. And I think compared to the last quarter's earnings reports, where expectations were very low, and generally speaking, we were still kind of very much sold off from the bear market. I think this time around, right, we're kind of at a stage where expectations are pretty high. And, to justify further multiple expansion, you really got to see these companies nail their guidance and really guide higher. Otherwise, there's no real point to being long at this stage. But yeah, I mean, I think it's going to be interesting. It varies from industry to industry, sector to sector. I am of the opinion we're in a rolling recession where there's going to be industries that are struggling, and there are several industries that are struggling. That's what people don't see in the bigger picture. But that doesn't necessarily mean that other industries don't rally or other industries don't see good times. I mean, nobody wanted to put their money into tech last year, and now everybody is like at this fear of missing out stage into tech and pouring record inflows into tech. And I think some of the underappreciated areas of the market may even rally. Yeah.
Yeah, I agree with the fundamental too, but I mean, like if you talk about the EPS, right? I mean, history speaking, like it's always EPS always like like if you see about the bottom EPS in the stock, right? EPS kind of like delay. If you talk about the bottom, you want to wait until the earnings like bottom. It will be like too late to buy the stock, right? Because it's kind of like a delay between the EPS bottom and the stock bottom, right? Maybe like 6 months, could be 1 year, right? So I mean, I read one report from I think Fidelity, right? They kind of like say most of the time, actually, what if actually like people waiting for earnings to be bottom? Maybe it's too late, right? Because we know that 6 months before they bottom, the stock bottom first, right? So, and I think like you said also, it's hard to believe, but now like what people say that they lower the guidance already. If you talk about the high expectation, I kind of like disagree because they actually lowered the guidance already in the first Q1. So now they have like very low like say estimation. It's very hard, very easy to beat now because they
Yeah,
lower.
I think it depends on what industry you're talking about. But I mean, expectations are very high for big tech this quarter. I mean, especially after the guidance that Nvidia and some of these companies that have been driving the market, right? The Magnificent Seven, they have given very high guidance, and as a result, I mean, the companies have been doing well with their stock valuations and performance, right? And some of that is justified. I mean, some of these companies are doing some groundbreaking work in AI, and they have some groundbreaking technology. However, for me to see them kind of create new all-time highs after they've already created all-time highs or near 52-week highs after setting another 52-week high up like a week or two ago, I tend to be more cautious than optimistic. You don't have to share my view, and probably I would say 9 out of 10 people who are probably into the stock market, they don't like short sellers, but I think short sellers are necessary to humble the market,
I agree with you.
And I will
and
say
get
this.
valuations in check for what they really should be, right? Because if we have a runaway market, we're just creating another asset bubble, and that asset bubble will eventually crash.
Yeah,
And
I know, but I mean, I'm also like do long and short. I mean, don't get me wrong. I also like short like a lot of tech 2022, right? I mean, I also do long and short, but like you said about the equity valuation, like Microsoft, they can justify their valuation, like Nvidia, they can do it, right? So I just feel like, and also market is not just like big seven,
what
right?
we're about to
Like,
find out is my point. I mean,
I just
earnings.
missed Bill. I
Yeah.
was trying to ask him a question. Snap. Sorry, guys. Continue.
Yeah, I was going to say we're about to find out. I mean, you're going to get earnings, right? If you want to see the financial health of any company, you look at their earnings report and you listen to the call, and you listen to the call closely to see what the future expectations are. To be perfectly honest with you, right? I have a hard time being bullish at these all-time highs for a lot of these stocks. And I think so far my thesis has been more or less correct. If you look at what's been happening to companies that have already reported, right? I mean, Lockheed Martin reported their best ever quarter, and they gave their best ever guidance. The stock sold off heavily today. Same thing with Delta. I mean, Delta had a phenomenal quarter and phenomenal guidance, and they sold off heavily as well. I think that a lot of people, right, and I think this is a classic mistake of retail investors and this fear of missing out mentality or follow the herd mentality, is that, people like to kind of come in right when everything is hot, and people are kind of afraid of missing out on the next big thing, but nobody wants to buy something when it's cheap, and nobody wants to touch it, right? And it's funny how people are loving Meta at this valuation, but nobody loved it when it was at 88 or 89 last year.
I do love
Right?
Meta.
So,
I do love
so
Meta, but now
and
like
and
if you
and,
see
and
most of the analysts now they upgrade, right? Like what you're going to do? Like you're going to follow the bank analysts every time they upgrade their stock, it will
well,
go
sure,
high.
but you got to understand, mate, that is a long-term price target. That's not a price target that they plan on tomorrow or day after tomorrow or even a week or even a few months from now. I mean, that's like their 1 year price target, or for some analysts, it's even longer than that. Again,
It's price in, right? This always market. The equity always like price in now, right? Like for example, like the like you said about, I know it's 1 year, usually 12 months, analysts, but every time if you see the news, let's say about upgrade of Tesla, it will go 2%, 3%. It means they price in the same day, right? I know it's like 12 months technically, yeah, I know that, but they price in. I feel like the equity always like forward-looking price in, and that's why now like all the gain,
absolutely,
right?
yeah, absolutely. Equities are forward-looking for the most part, at least. I mean, some people have a different theory, but that's my experience. The problem is that and this is how I see the market. People can see the market differently. I think that the good news is already priced in. And I'm not saying that we're going to see a recession and we're going to go back to October lows or see new lows. All I'm saying is, right, don't be panicked if you see a pullback and you see a healthy
All right.
pullback.
Yep.
Um,
Yeah, I
you
think
know, yeah.
we might see a little bit of a healthy pullback, but we've been ripping and rolling here for 3 hours now, so I appreciate everybody coming on. David and I host these starting at 8 o'clock every Tuesday night. As I appreciate everybody coming up. Stock Talk, Money Flow, Mel, Deep Barrett, Investment. We had a bunch of great speakers previously as well, so the space is recorded, so feel free to go back and give it a listen. Also, shameless plug, I've posted my YouTube Up in the Nest. I have a great Macro Insights podcast I think you guys will love. So be sure to check that out. Subscribe to the channel. And be on the lookout. Follow everybody up here. There's going to be a lot more spaces this week. So thanks everybody for tuning in. And I'll see you guys on the other side.
And thank you very much, Brendan, for hosting the space. And I will give a quick shout out because it is well deserved. Congratulations, Barchart, for obtaining the 90K follower and great platform. It's well deserved, and I love the initiation you guys do, essentially giving a lot of options and or data flows for individuals that need it. So thank you, guys.
Yeah, shout out Barchart. All right, great stuff, guys. Y'all have a great rest of your night.